Happy New Year, everybody. I hope you had a great New Year's Eve. I hope you're excited for an awesome 2024. I really am, and I'm not being sarcastic. I think it's going to be a really good year for the markets. In today's video, I'm going to talk a little bit about the real estate market. I'm going to talk about crypto. I'm going to talk about the stock market a bit, including dividend stocks and things like that. So stick around and enjoy the video. So for those of you who don't know me or haven't seen the channel before, my name's Adam Kahn and I'm the Rational Investor. I hope your day's starting out good. I hope you're as excited for the year as I am. I really do think this is going to be another very good year. I think similar to last year, people are going in pretty negatively, which is a great sign. I mean, I try to go against the herd. Before I forget though, and before I get into the video and why I think that way, if you guys could do me a favor and hit the subscribe button, possibly even hit the like button, I really appreciate that. It helps the channel, that helps YouTube's algorithm, helps other people find the channel. So if you like the things I'm talking about and find it interesting, I really appreciate that help. I'm also going to put a link in the description on opening an account at SoFi. Um, I encourage you guys to open an account at somewhere. You don't have to use the SoFi one, but what I hope out of the channel is that I encourage people who may be nervous or uncomfortable investing to start investing. And it's really super simple. So anyway, if you do use that link, if you deposit $10 or more, SoFi is going to give you an additional $25 for free as a gift. It also gives a gift to an account that I opened up with my son. He's 13 years old. I try to teach him about investing and savings as well. I think it's really important to start young, and when he gets the gifts in the account, it really gets him excited. It keeps him engaged, and versus just his dad trying to explain it to him, which might be a little bit different results. So I appreciate that as well. And I can't tell you how excited I am to see how the channel's grown. We're up to 2,500 subscribers, and I just want to say thank you guys. I really do appreciate that. Every single one of you who's actually taken a second to hit the subscribe button. It's really cool and it's really nice. So from the bottom of my heart, thank you. I appreciate those guys who are finding it interesting and women as well. Also make comments. Let me know what you think. I really don't mind debate. So if you disagree with some of the things I'm talking about, by all means, tell me why, and I'm happy to discuss it. Now, on the original note of people going into this year being a little bit negative or a lot negative, I feel like a lot of people have rushed into CDs and treasuries and high yield savings accounts and things like that because they see all these doom and gloom things out there that scare them about the markets. You know, our credit card debt has gone over $1 trillion. The foreclosure rates on properties are going up dramatically. The repos on cars, all of these things that sound super dramatic as if there's some big doom and gloom coming in the future, but the reality is if you take those things and put them into context, they may make sense. And on top of that, none of that is anything that is new or unique or things that the fund managers are not aware of. So let's break down those things to begin with. The $1 trillion in credit card debt. Well, to be fair, we've had inflation. I'd have to look to see what the credit card debt was a few years ago, but if your grocery bills have gone from $40 a week to 80, your credit card balance might have doubled as well. So you're going to naturally have higher credit card debts just because of the inflation. Now, the only thing that concerns me about that is the interest rates, but there is going to be a certain amount of credit card default as well. That's how the cycle works. And if you look at like Visa stock and some of the others, well, they're making new highs. It's hard to imagine there's this big calamity that it's all going to default and it's this awful position where it's going to crush the economy. And the companies that are running those things are still chugging along and doing really well. I really don't see the credit card um, debt as this huge doom and gloom dire problem. I do think for many individuals, they've built up too much debt, period, whether it's credit card or whatever it is. And I don't think the US has an income problem the way that a lot of the videos talk about. I think a lot of people have a spending problem. I see these comments of people who are talking about really struggling who are making six figures or more. I did a video on that a little while ago that it's not as much money as you think. But at the same time, if you're making 50, 60, 70 grand, and God forbid you're actually a two income household making that type of money, Well, you have to look at your spending and find places to cut back, and you just do. And you can afford to live. I mean, the woman in one of the videos I heard talking about complaining about the grocery bills, when she started talking about the things that she bought, well, they were easy things to kind of make alternative selections on. I'm not trying to make a judgment, not trying to be difficult, but what the Fed was trying to do was slow things down. Well, slowing things down might mean you can't afford all the things you used to. Doesn't necessarily mean you can't afford to live, but my wife and I, we used to go out to dinner, I don't know, 3, 4, 5 times a week prior to COVID. Now we go out once every 2 or 3 weeks. We enjoyed it, but the prices have significantly gone up. We still enjoy going out, but we had to make those conscious decisions of, geez, the prices really have gone up a lot. We can't go out all the time. We have to make these decisions and change our behavior. That's the slowdown you're seeing, but it doesn't mean we no longer can afford to live. Similarly, in terms of the grocery bills, well, we've done a really good job of clipping coupons. And to be fair, I think we live a pretty good lifestyle. But I don't feel that same pressure at the grocery store that a lot of people are talking about. And I don't see it being as expensive as some people feel. But we're really cautious about what we buy and when we buy it. And there are good deals to be had. The other thing is I saw Graham, I think his name is Graham Stephan, talk about 84% of people think right now is a bad time to buy a home because prices are high and interest rates are too high. Well, I like to go against the herd. This is part of the reason I think that it's the right time to be buying. If only 16% of the people think it's the right time to be buying, and you don't see the house prices dropping, right? You have 84% who think it's going lower, and only 16% then must think it's not a bad time, and they're supporting the market. What do you think will happen as the rest of the market starts to think, geez, maybe it isn't so gloom and doom? I don't see the market falling the way I expected, and it continues to drift higher. As that other percentage then comes into the market and they start thinking, geez, maybe I was wrong about that, you're going to naturally see prices go up. The other thing is, if you look at what's happened with the 10-year bond, it's already fallen. So interest rates for mortgages are already beginning to come down. If you go to the CME.com, which is really easy, it's the letter C, the letter M, the letter E.com. You can see all sorts of currencies and treasuries and all sorts of things that you can watch on the futures exchange. And one of the things is expected Fed fund rates. Well, they're expecting 4 to 5 cuts next year, and from what the Fed's doing. I don't know that that's 100% accurate, but what I do find is in terms of their Fed estimates, they're usually pretty good. And as it gets closer and closer to the date of the Fed announcement, they're pretty much spot on in terms of if they're right or wrong and what their thoughts are. And they even see a possible cut as early as February, but more likely around March. Well, if the 10-year continues to go lower and the Fed actually starts cutting rates and mortgages continue to go lower, most people buy a home in terms of their monthly payment. If the mortgage interest rates continue to go lower and the market's already holding up, I know it came down about 5-10% this year, but it's not the big crash everybody's expecting. But if people are trying to buy a home based on their monthly payment and you see the interest rates start to fall, well, I think it's going to support the market, and I think you're even going to see prices begin to go up. On top of that, when the Fed was raising rates, generally, now this is not a quote, this is not a specific, this is where interest rates are, but it's a rough way to have an idea where mortgage rates are. For years, if you looked at the 10-year bond, generally the spread or the margin between the 10-year and a 30-year fixed rate mortgage for somebody who had good credit was about 2%. When the Fed started raising rates, that increased to 3%. I think it was a buffer for the Fed to be able to continue to use rates, and a little bit of nervousness of the economy was struggling and everything else. Well, that margin's gotten bigger. As they start to cut rates, that margin is still at 3% right now. But as the Fed starts to cut rates and the banks and the lenders get a little more comfortable that, hey, maybe things aren't so bad, and maybe I don't have to worry that they're going to continue to jack up rates and we don't need that buffer, you may see that margin come in as well. So you add those two things together, and if the Fed's cutting rates and the margin between the 10-year and the mortgages start to come in, you could really see rates get down significantly, which I think is going to just push prices higher. This thought process of, well, the people who are in with really low interest rates are now going to feel more comfortable to sell. I find that a silly argument. I don't see a huge influx of inventory behind that. I think a lot of people got in really well, and the ones who already own homes might be in the position to buy another and rent that one out, which is why I don't see rents going up a whole lot in the meantime. I think you'll see a compression of the potential income on somebody can make on a rental property, especially depending on what part of the country they're in, because if you live in Florida and Vegas, those are the two I'll harp on. I think they were so undervalued for so many years that COVID just sped up the speed, kind of funny, sped up the time frame it was that it would take for those to make more sense. Florida is an incredible place to live. You have the ocean. It's like being in the Caribbean, but attached to the continental US. Well, Vegas is a great place too. We're really close to California. We have all sorts of entertainment and great food, and it was super inexpensive. Once those places started reversing to where they're more expensive than where the average person who works there can live, that actually makes more sense because you have the demand from the people who live there and work. But you also have people who visit who want to own property there too for when they come and visit. And a lot of times these are wealthy people who can afford second or third homes. So that drives the prices to be more expensive than what one would think. I don't see that as anything that's ever going to change. And what I use as an example is look at Hawaii, look at California. I'm sorry, these places are overvalued for good reason. Everybody wants to own property on Hawaii. Do you think the average employee in Hawaii can afford to buy a property? Do you think there'll be a time in our lifetimes where all of a sudden the prices will make more sense and oh, now it's just totally reasonably priced because the math didn't make sense? No. Neither will it make sense in Las Vegas, and neither will it make sense in nice places in Florida. They have just changed the dynamics, and people who vacation there and go there and realize what great places these are now going to continue to keep them elevated in price. If you look across the country, there's plenty of good deals out there. Not to be tough on them, but look at Cleveland, look at Cincinnati, go look at Pittsburgh. I think their prices are still really reasonable, and I'm quite sure there are plenty of other places that there are as well. They're less desirable places to live. And since COVID pushed people out of their boundaries and out of their comfort zone, and the work from home thing became such a big thing, now they all of a sudden started looking outside their little communities into places of where would I like to live? Not where do I need to live for work, but where would I like to be? I think maybe you have that come back in a little bit, but you'll never see it go back to where it was. I don't picture a time when you're going to be able to find really inexpensive homes in these great vacation places. So, what do I picture in housing? I picture lower interest rates and higher prices. I actually think come March, April, or May, you're going to see people bidding on houses again here in Las Vegas. Now, you have to do your own research. You can't listen to me. I am not a financial advisor. The information I am giving is not financial advice. This is just my opinion. You have to make your own decisions and not listen to me. And for that matter, I don't think you should really listen to anybody on YouTube. And you need to make your own choices financially, what makes sense for you. Because even if I'm right, it still may not fit your situation. And if I'm wrong and it sure doesn't fit your situation, I don't want to see anybody making bad financial decisions thinking, oh, I listened to this guy and he said this or that. I also see similar with the stock market. I have a concern that maybe the first couple weeks in January, they always say the first week is an indicator of how the markets go, but I've seen that divert from what people always have said in the past. I worry that the first week or two we might have a decent pullback, maybe even the first month, because we had such a big run up at the end of the year. But I'm bullish stocks. I think the market's going to do better and better, and I don't think they're as overinflated as everybody seems to tout. I really do think everybody moving into CDs and high yield savings and treasuries because they're scared is the reason the markets are going to go higher. I think the sellers are out of the market. Doesn't mean that if it doesn't get too high that sellers won't come in. But I think most people have already gotten scared out and the scared money is gone. So now it'll drift higher until the money starts to get nervous of I'm missing out. and the FOMO really kicks in. There's a lot of YouTube talk about FOMO, but I don't think it's really going on. I think they've already been feared out of the market, and they're all talking about this FOMO, watching the market go higher. I think the market's going to continue to go higher until that FOMO really comes in. I'll tell you what I look for, because I remember this in Chicago when the big boom happened um, for the internet bubble. Now, I lived in a high rise at the time. Anytime I would go in to visit a friend who lived in a high rise or come home to my building, the doormen were talking about, oh my God, did you see this stock? Or did you see that stock? Or did you see the other? Now, we didn't have Uber and Lyft back then. Anytime I got into a taxi, same situation. The taxi driver was talking about the stock market. Everywhere you went, everybody around was talking about the market. To me, that's what you look for in a high. When everybody around is, whether it's real estate or stocks or crypto. I mean, how about when Bitcoin went to $60,000 and changed the first time? Anytime you're talking to people who don't really get involved in markets and they're talking like professionals about things that they aren't typically involved in and how it's just going to go higher, to me, that's the sign of when things are overinflated and it's probably a top. Which brings me to crypto, which I know I said I'd talk about a little, especially because somebody asked me. I feel the same way about that right now. Nobody's talking about it. Meanwhile, Bitcoin has drifted from like 13, 14, or 15,000. My numbers are not going to be exact, all the way up to like, I think it traded as high as 45,000. I don't hear anybody talking about it except the people who really pay attention to crypto. Now, I don't know anything about crypto, so it's very hard for me to invest in the things I don't know about. But I can tell you a market that's drifted up that high in a year or so that nobody's talking about probably has more legs. Now, that's just trader talk. That is not knowledge of what I think about crypto. Because I want to repeat, I really know nothing about any of them. But it's amazing. I try to read about it. I read about the one Solano and saw that Visa came to some agreement with them. My God, the thing's gone from $8 to over 100 this year. I don't hear anybody talking about Solano and Bitcoin going up and Ethereum's gone up. And I've seen there's a lot of these altcoins that I really know nothing about that have had really big moves that nobody's really talking about anymore. If Bitcoin gets to 80 or 100,000 and everybody starts talking about it, and I go to a party with my wife and the friend of hers who was talking about crypto back when Bitcoin was at 60,000 starts telling me about some altcoins that he's been looking at, well, then I'll be concerned that it's a top. But in the meantime, when we go out and we see friends and nobody says one word, or I don't hear anything about Shiba Inu or Dogecoin or whatever it was that was so popular not that long ago, my feeling is it probably keeps chugging along. Again, not financial advice. I wouldn't be going out and buying a bunch of crypto, especially, it's super risky. Even if I am right, I don't know how you pick the right ones. Um, but my thought process is it keeps chugging along until people are talking about it. It probably keeps going. And my real out there thought on crypto, especially the more that we've had hacking, I have a feeling like my kid or grandkids' generation is going to be looking at the World Wide Web going, oh my God, I can't believe Grandpa Adam used to have a bank account on the World Wide Web like that. I feel like 12 and 13-year-olds will know how to hack and get into accounts and things like that because our current system is probably really just out there and that blockchain is much more secure. Now, I don't understand it. I don't have a real knowledge about it, but I do think that those who do understand it really do. And one day it'll make more sense to us and we'll probably be on a blockchain for a lot of things. So I wish I knew more because I probably would invest more in it. I do have some money in crypto, but I keep a small enough amount that if it goes to zero, it's like I don't really go to the casinos. I might play poker, but uh, it's throwing it on blackjack. If it goes to zero, it goes to zero. That's my comfort level in crypto. I don't want to take any big bet that I think is going to impact my family or my life just because I don't know enough about it. And if that means I make investments that don't grow at the same pace, well, it is what it is. And then possibly the last topic I want to touch upon is dividend stocks, which I love. I am a dividend junkie. But every year at the end of the year, I try to reevaluate portfolios and I take a look at them and see where I could do better, or what's going on, and where things are working out. And my brother for years has been taught, I don't want to say laughing at me, but explaining that dividends are not as wonderful as you think because there's multiple problems with it. And I'm going to give you one example of two stocks and compare the two of how I've done with them over the past few years. So I'm a huge fan of Altria stock, and the reason being it pays like 9-10% yield. I invested a decent amount in Altria, and I put the same amount into Amazon. Altria has paid their dividends for the past few years, but the stock is down 20%. So over the 2-year time frame, I've essentially gotten 10% of dividends each year, but I've given that back in equity. The dividends are taxable. So I've paid taxes on 20% that the stock value has lost. Whereas I put about the same amount in Amazon, which is up 60%, but it does not pay a dividend. I don't mean to use Amazon because it's outperformed, but the stocks that I really like that don't pay dividends are Google, Amazon, Apple, Microsoft. Like, it's these great companies that continue to outperform year in and year out. So I don't know why it was light bulb going out off in my head this year when I looked at the Altria and saw it was down 20%, but I've been paying taxes on it the past couple years. And I haven't paid one penny of tax on my Amazon stock that outperformed it when I put the same amount of money into both. And then recognize what he was trying to tell me is if I want the dividend from Amazon, well, if I buy 100 shares of stock and I need to sell one or two of them, the way that the accounts are set up now, they don't charge commissions the way they used to. I can sell the one or two shares and get my $200 or whatever it was that I was getting in the dividend that made me feel warm and fuzzy. So I'm trying to think this year, I do have an account that's specific to dividends and I like them because they pay my bills, or some of my bills. And I don't want to change that. But I am going to reevaluate the companies a good bit to make sure they're in companies I think have growth potential as well. I don't think I want any more of the ones that just draw me in because of the yield. And I want to start moving them to the companies that I just think are better companies. In a video I did either yesterday or the day before, I talked about Caterpillar, which I don't even own, and partially because they only pay a 1.75% dividend. Well, how silly is it that I'm not invested in a company like Caterpillar where I see it growing and growing over the next 10 years, but I am comfortable in Altria because they send me a dividend check that I'm paying taxes on? I think I have to rethink it a little and just make sure I'm in great companies. I know I'll talk about Tesla a little, TSLY, and I'll tell you why I really don't like the stock. And I'm going to totally make up numbers, but well, most of them. But Tesla closed the year right around $250. If it falls from 250 to 210, and I am not predicting that that's going to happen. I actually own Tesla stock and I like it. So I'm not saying there's any reason I think Tesla is going to fall. But if it does, TSLY will fall precipitously as well. With the call cover strategy, I'm making up numbers. If it falls from 12 to 9, they then readjust the price of the calls they're selling to get people yield. So they've reestablished that $9. It's not like you're really going to grow back up to 12 if the stock goes back to 250 over time. Now, I think Tesla's going higher. I think it's a good investment. I don't love TSLY. I also don't love that they use synthetic call option strategies to be long the stock because that tells me they're most likely leveraging to sell more calls to generate more yield. It's not a terrible strategy, but it is a lot of risk. So when I hear people taking on margin to buy these things, or I hear retirees getting into them because they're super attracted to something that says it gets 60-70% return, but it changes every month and could drop dramatically. If you put 20 grand in it and it drops in half, well, even if the yield is 30%, you're going to be getting 30% of half of the investment. you're not going to get the 30% of the original investment. So it's more that I'm concerned about the risk that it takes on. I understand why people like them. I get attracted to yield as well. In fact, full disclosure, I have 100 shares, but I'm not super concerned about the 100 shares, and just want to see how it plays out. My concern is partially because these things exist, that there'll be enough of a correction to really clobber people to show them what it means to be having that type of strategy. I'm less concerned on a well-diversified one that tries to use calls to try to make a little bit more money. I sell covered calls myself, which is why I don't want to overstate it. I don't want to make it like it's the worst thing in the world, because I think there's good opportunity there. I think you just really have to understand it and not just throw your hands in the air and think, well, these are professionals doing it and they're really good at it, so I don't have to learn it. Well, the professionals aren't always really good at it. So maybe they are, maybe they're not. And the guy who runs the fund, Jay, whatever his name is, he didn't make me feel warm and fuzzy. I mean, he talked about the real way to make money, and it is just to reinvest your dividends. Well, a lot of people are getting these funds because they want those dividends to pay their bills. If the only way for it to work is for you to keep putting it in, it defeats the entire purpose. So I advise you guys to really learn a little bit more about the strategy they're using and decide if it really makes sense for your portfolio. I think there's a really small percentage of people who should really be utilizing this. And my concern, and the reason I said it in a few videos and made one specifically about it, is it might not be the right people investing in it. It might be attracting people who really can't afford the loss if it doesn't go the way they're hoping. I mean, they point to Coney about how well it's done. Take a look at the stock, and if you just bought the stock at the same time frame, my guess, and it's just my guess, is that you're better off just accepting the ups and downs of the stocks that you like and owning those stocks instead of the way that they're doing these covered call strategies. Anyway, that's my advice on the real estate, on the stock market, on these high yield funds, on crypto. Just a way to start the year. And Happy New Year again. Thanks again. Don't forget, subscribe if you made it this far. Woohoo! That's so cool. It's hard for me to sit through boring me this long. Anyway, so again, like, subscribe. Have a great 2024, and hope to see you tomorrow.